Well, good evening. It is the 7th of December. It's Tuesday, wherever you might be in the world or here in South Africa. It's a warm welcome to the BizNews community. Ladies first, Emma Swart, who is a director of OrbVest South Africa. Congratulations, Emma. Our community know you from the conferences. Congrats on your promotion. Is it going to make any difference to the way you go about interacting?
Thanks, Alec. Hopefully the big bosses will listen to me now.
What are those big bosses?
Yeah, as no doubt you picked up, Alex. She's actually a lot fiercer than she looks.
Yeah, our community know Emma from the Drakensberg events, and I'm sure from many of those who have invested into OrbVest. But Justin, it's been a fantastic ride. How long now have we been partners and in fact had BizNews community members investing with you?
Well, Alec, I think it's around about 3 years. Remember, we started off in about 2018 as OrbVest in mid-year, and I think it was a couple of months after that we started doing our first chats with you. And yeah, it's been a fantastic road, and we've got a lot of the community who is involved. So thank you for that.
Well, they are thanking you because the investments they made were at rands that actually bought a heck of a lot more than they buy today. And talking about rands, Andrew Photos is your counterpart in the US. How are you related to OrbVest, just so that our community know where you fit in, Andrew?
So I am with my counterpart here in the United States who just moved from South Africa on the acquisitions team. I'm also in charge of facilitating the funding for all of our projects. And then I help oversee all the assets under management currently in the entire portfolio across the country.
What time is it in Atlanta?
It's 12 o'clock noon.
Okay, so it's a pretty good time then, because often we get your colleague Martin Freeman complaining that it's so early in the morning in New York and certainly in the middle of winter. Justin, where's Martin at the moment? We were expecting him to join us as well tonight.
Yeah, I'm afraid he had to go to a Lincoln Harris Congress, and he's stuck in the air somewhere. So apologies to the community, anyone who is waiting to hear from Martin. He's always quite entertaining, Alex. So apologies for that. But I think that we'll make it up with Andrew, who's right in the thick of the real estate space in the US, as well as Emma.
Well, great to have you all with us as always. Okay, so just to set the background, the BizNews community really love OrbVest. There have been investments made now over the past 3-4 years, and as mentioned earlier, at relatively low exchange rates, or relatively, well, better value exchange rates. So difficult with the rand, because the rand goes up to 18 and you think you forget that it's actually weakening. But the reality of it is many of our community who invested in OrbVest missed the stock market crash. And I'm sure that had they not invested with you, that money probably would have been stuck in Wall Street and declined dramatically. Have you found that to be something, Justin, before we go into a little presentation that you've got for us, that's a familiar theme with the South African investors? And maybe, Emma, it'd be nice for you to come in as well on this.
Indeed, yes. I think, yeah, those of us that got into the buildings at the right exchange rate. I mean, I've just returned from the States, Alec, and it was actually quite an unpleasant experience from a rand point of view. I can tell you that. Yeah, no, those that got in, first of all, you haven't had the decline that you would have had if your money was sitting in stocks at the moment, depending on obviously when you invested. And secondly, of course, the exchange rate.
Emma?
Yeah, and I think, yeah, Alec, just to your point there, you know, with these investments directly into a property, it's not subject to market volatility. You know, you don't have something happening in the world and suddenly the price plummets. You have, you know, a hardcore asset with strong fundamentals, with an income stream, you know, getting your yield. So I think that's obviously played in our favor from this type of investment compared to the market.
Before we go into our little presentation from Justin, our colleague Stuart Lohman is with us as always. Stu, Do you want to just test that all the tech is working the way it should?
Thanks, Alec, and welcome all. Those new to the go-to system, on your control panel on the right-hand side, there's a little high five button. If you can't see four pretty faces and hear my voice, can you give us a high five if you can? Sorry, so that we know it's coming through loud and clear. Got some high fives coming through, Alec, which is always a good sign. Thank you very much. And I know Alec and the team like to keep it quite conversational. There is a little question mark on that same control panel. If you can please put your questions in that question box, and Alec and the team will get to it. But thanks a lot, Alec. All good this side.
Brilliant. So just to reiterate there, on the question box, I see somebody says, oh, and by the way, the way we handle those questions as well, we only talk about, or rather we only refer to you by your first name, not your surname. So you can be quite confident that someone or anyone who you don't want to know who you are won't ever, because it'll be Bill or Smith, or in this case, Daphne. I hope you're able to hear now, Daphne, and that it has come through. Justin, I know you spent a lot of time putting together a few slides. We are standing by for you to take us through them.
Well, Alec, I know how you hate slides. I think your normal rule is, what is it, 5 slides or something? And we always get away with a few more. But I think, just to try and illustrate some of the points that we always talk about, it's nice to just to have some a few slides to talk us through it. But if we can talk generally, Andrew, the big question that we always have, Alec, is questions about the US economy, specifically relating to commercial real estate. So maybe he's a better one to jump off on this, Alec.
But don't you want to just take us? There we go. All right, there's your slide presentation. All yours, Justin. I mean, we are all in your hands. All
right, excellent. So I'm going to get Andrew to talk to this just now, because I feel that he's in a far better position to discuss interest rates. Bear in mind, he is responsible for sourcing capital for all of our deals, Alec, and there's a lot of really great questions there that I'm sure you want to ask about, what rates we're getting money for at the moment, what's happening with home loans, etc. So I'm going to just jump a little bit quickly to our little space, the medical commercial space, because the question is, what on earth are you guys doing right now with the sort of rates that they are at the moment? Are you able to acquire buildings? What's happening to the portfolio? And I must say, real estate is not a straight line. Certainly, it's a lot more complicated in the States than we all thought it would be. But the interesting thing is that our little segment of medical real estate, this is what's happening. And this is fascinating. If you have a look at, it's a little complicated, guys, but if you have a look at the pink bit, that is 2020, okay? That is the year of and after COVID. And then the 2019 is the blue bit, and the axis on the left-hand side is the amount of square feet that actually were sold. And so what you're effectively seeing is the real numbers in terms of square feet have moved over to 2020 in a very, very big way. If you have a look at the price per square foot, $300 per square foot was by far the biggest price in 2020 compared to 2019, where it was just over 10 million. And the whole graph has moved up. If you look, there's higher prices, much more transactions happening in the $400,000 and $500,000. And this is a result of COVID. People suddenly realized that, do we want to be in office? Do we want to be in the stock market? What's going to happen? Let's take our money out and let's put it into medical real estate, because, hey, the doctors are still practicing. The medical rooms are taking some of the overflow from the hospitals that are closed. So I think that was that's very interesting. And I've used other sort of slides in your presentation before just to illustrate this. And here again is the cap rate. And just to make everyone understand, the cap rate is effectively the return that you would get on a building if you paid all cash. And in the old days, we used to talk about, and once again, look at 2019 in blue, cap rate, $20 billion of volume of property sold, between around about a 5.5 cap rate, if you see that nice big column. And look what happened in 2020. It dropped down to the biggest column in red is 4.5. So buildings were significantly more expensive and much more volume changed hands in this medical real estate space. And I think that is indicative of the market. And I think really that's pretty much all I wanted to say. And then maybe if you can give the hard questions to Andrew to catch him out there, Alec.
Yeah, and if you would. Sorry, just I'd say on that one was, if you're talking about the transaction, volume, year to date, we have had over $20 billion worth of medical office building transactions that have taken place, versus just over 10 billion and 13 billion in the preceding years. Another factor, again, back to your office, your industrial, that kind of space we're chatting about, is the large number of the US population that are covered by our, as we know them, our medical aids. In 2021, the insured population hits 300 million people. Again, the resilience of this space, because your medical aids then almost guarantee our doctors or specialists getting paid, who are obviously our tenants and pay the rental on these properties.
Justin, why don't you go back one slide, please, because I'd like Andrew just to unpack this for us. So from the way you've explained it, the cap rate has reduced. And in other words, that means that you're paying more, or you're paying up more for properties. Is that correct, Andrew? Am I reading it the right way?
That's correct. That is
just
correct.
Explain what's the difference between a 5.5 and a 4.5 cap rate?
The difference is at a 5.5, you're paying less. What you're doing is you're taking that percentage number and you're dividing it by the net operating income of the property, and that's your purchase price. And it's a relation of a few things. One is where rates were at the time. In the United States, up until about 6-7 months ago, rates were at their lowest they'd ever been. That drives also the cap rate at which you would buy a property, but also demand. To Emma and Justin's point, especially in the medical office, if there was a lesson learned from COVID, it was that medical office properties were more resilient than traditional office properties. In comparison to retail and traditional office, which took a tremendous downturn in their occupancies, the only one that wasn't as adversely affected, other than medical office, but has always been popular, is multifamily.
Which is what?
Apartments for families. So a complex that has anywhere from 50 to 350 units where families are living, earning rental income.
So getting back to your game, to OrbVest's game, does this mean that buying properties has been more difficult? That and really the follow-up for that is you've got some big ambitions at OrbVest, NASDAQ listing, billion-dollar business, etc. Are you, because of these higher prices, holding back on your purchasing or on your investing of properties now?
Yeah, I'll jump in there, Alec. Absolutely. I think that as a business, we aimed to acquire 10 buildings like we did pretty much last year. But our business is not just acquiring buildings. Our business is about giving investors a return. And if there is no delta or difference between what we're paying in terms of the cap rate and what we're paying in terms of the interest rate, if we're buying a building at a 6 cap and we're paying 6% interest for it, there's nothing in it for the investor. So effectively, in the last couple of months, you will notice, Alec, we haven't been here talking about new deals that we bring to the platform. So it's been a kind of a few months of very, very careful underwriting and consolidation. And we'll talk a little bit about the consolidation later, because the ODH, our sort of diversified product, is really what we've done to consolidate. So it's been about being a lot more careful. We closed 41 about 3 months ago, and we closed 40 yesterday. That's why Andrew is, or certainly was, down in Albuquerque yesterday. So yeah. We've been very quiet. As I say, we've only done those 2, and we've been very conservative with underwriting. It's better for us not to take on trouble, as we've learned, rather just to be conservative and wait for the market to turn. And we anticipate that what will happen is the cap rates will start to correlate slowly with interest rates as interest rates start to come down. And that means there will be a great opportunity at that window where those 2 lines intersect. So ultimately, we're expecting that we'll be back in play next year, and we're just sitting tight while things are crazy in the US right now.
Is there a argument then for holding on to your properties for longer than the normal period that you tell investors that you want them for, i.e. the 5 years?
Alec, there's some great arguments, or certainly discussions that we've had, especially at some of your events in the Drakensberg, when you get to sit down with a bunch of investors. And I think the question is a lot, why on earth do you sell the building after 5 years? After you've got it, you've gone through all the pain, you fixed it, you filled it with tenants, and now you want to get rid of the thing. And I think that I've got two answers to that. One, we've already done it with one of our properties where we've got to the end of the 5 year period. We've gone back to investors and said, guys, it was Medical 7, like I said, Texas property. This building is fine. Yes, we can sell it, or we can refinance it. In other words, we go to the bank and we get some equity out. We return that equity to shareholders. We pay them back a little bit of their capital. And ultimately, what that means is that instead of having $100,000 invested, they've got $80,000 invested in a building that's still generating the same return. So your return effectively goes up from whatever they were getting, 8% to 9.5%. So they're getting a higher return, cash on cash. And I think that, you know, you're probably going to see us trying to do this a lot more in future. But the big thing is, and the learning here, Alec, is that property is not a straight line. And if you buy a single building, you get these little bumps along the way, which we find quite stressful. And by consolidating them, that's why there are funds, because they put the properties in and they can give you a nice balanced return over the portfolio, and you don't have to deal with these little bumps and hiccups. So I think, yeah, holding the buildings longer and grouping more buildings together is, I think, definitely a direction we'd like to go in the future.
Andrew, from what Justin has said and from what you know of being on the ground in the market there, is this an unusual approach for people in this area?
No, it's not an unusual approach. I mean, look, the United States, if anything, the economy is cyclical. There are times where we go up and we go down. This is going to be in my career, my fourth cycle where we had very low rates and rates are going up. It's just a matter of the peaks and the valleys and how wide they are. This cycle is very interesting. We have a lot of things going on that I haven't seen since the 80s. Things are also, though, changing faster. So, you know, what I explain to my folks is real estate's a living, breathing thing. You can say 5 years, but we have to see where we are in life, where the building is in its life cycle, what is best for it, what is best for the investors.
And it sounds like it's a very sensible and rational approach, Emma, that you can, or a story that you can say to your investors. Do they buy it? Do they exactly what Andrew says? No, and I get it, Andrew. And I think as anybody who looks at investing logically knows that it moves in cycles. And the last thing you want to do is to be buying at the top of any cycle. But emotions, the crowds, it's not always that easy. Emma?
Yeah, and Alec, I think, you know, back to the example Justin said on Medical 7, you know, if you're an investor and you've come in for a 5 year period, every investor in that building at the end of the 5 year period had the option to sell out, you know, to get their capital out, to get the returns that they had, you know, or had the option to remain in. So from that point of view, you know, your 5 year doesn't suddenly become a 10 year with no option for them to step out of that investment. You know, and second to that, I think the interests of the investor and OrbVest are aligned. So when you get to the end of that period, you know, OrbVest sort of makes their money on kicker at the end. So you know that OrbVest will be making the right decision in terms of exiting or holding a building, which the interest of the company is in line with the interest of the investor. And back to your, as you say, the market and what's going on, and what Andrew had said is, you know, if you get to the end of your 5 year period, the market is flat, buildings aren't selling, the cap rates, you know, haven't come down, you still have a decent building with a good income stream. So you may sit for another year, you may sit for another 2 years, but you should hopefully still be getting that 7 or 8%, in dollars per annum, where the tenants are still paying, and you may wait for the market to pick up and the cap rates to come down and exit at the right time.
There's a question, there are quite a few questions that came in earlier in the week, and we'll get onto those in a moment, but there's one that Mark has put up. He says, as a financial advisor, can I recommend OrbVest to my clients, and how do I earn something from this, Justin?
Yes, the answer is yes. We are a financial service provider, and we are regulated. So if you are regulated and you have the right codes, in other words, class of business codes, we can certainly talk to you. And there are many financial advisors that do sell this product at the moment. So we're very happy to chat to you offline.
Yeah, and I guess there are a lot of financial advisors that wish they'd sold this product in the years gone by, given what's happened to so many of the other products. Graham sent through an email, and I know you've seen this, so I'm sure you guys have got a really cogent response. The question is, I recently did a small test withdrawal, and it took a considerable time, at least 7 business days, for the funds to reflect in my US bank account. In addition, it cost around $40 from the OrbVest side, plus another $16 from my own bank. He's lucky. My bank in the UK charges £25 for anything, even if it's a £15 withdrawal. So they're now to charge, these international banks. Clearly, one should draw, he writes, a substantial amount to mitigate these fees. Is there any way that OrbVest can look at those charges, and are they able to speed up the process? I mean, you're getting into a new realm here. I do that from our side, our UK bank now. Whenever we do anything, we try and pay 6 months in advance rather than the $125 a month, which then gets a £25 charge on top of it. It doesn't sound like much to you, Andrew, $25, but if you put it into a South African context, it's almost what you would pay for all your bank charges in a whole month. Just that one transaction. Isn't that right, Justin?
Alec, this is such a wonderful question, because I wish, being a kind of a platform person, I wish we could make this absolutely seamless. But the amount of compliance and inefficiencies in the banking system when you go international is just crazy. And so I'd love to answer it just piece by piece. And Graham, we'll obviously get back to you. I'll investigate, what's going on to those fees. But first point is, number one, we're not involved in holding your money at all. We do not charge you any fees on the withdrawal at all, 0. Your money is sitting in the exchange in a trading account. And we have negotiated with the exchange that they charge you no fees on that account. So while that money is sitting there in that account, they don't charge you anything. Obviously, you don't earn interest, but you don't pay anything. And they earn no interest, by the way. But where they do make money is they do charge you if you are going to withdraw money out of their account and move it offshore. For that, they also do some validation, because they do make sure that the accounts all line up, and they do it pretty manually. So they do some work for that $20, but we are unable to get that $20 fee down. Remember, nothing to do with us. That's what they charge. Bank charges are exorbitant, and one of the problems, Alec, is that it bounces. Remember, the Seychelles sends it via a bank, a corresponding bank, before it gets back to wherever it's going. So there's always 2 steps in that process. And we do say, by the way, on the website, you should pay attention to the fact that a withdrawal normally takes, with this long process, between, and correct me if I'm wrong, I think it's between 12 and 14 working days, Emma.
Yeah, shouldn't be quite that long. It should be within that 7 working days that Graham experienced.
Correct. Yeah. So there's a longer period there, Alec, but it is unfortunately just how it works when you're bouncing money around the world.
Yeah, and probably he's come to his own conclusion, the correct conclusion, which is the one we've come to. If you're going to make a transfer, make sure it's substantial. Try and make a big one rather than taking little bits and pieces, because no one wants to work for the banks. Andrew, I suppose to you this is normal, or are we being a little bit penny pinching in this respect?
Look, we have similar fees here in the United States, but the exorbitant international fees, we don't experience them the way you all do. So I empathize and sympathize with our investors when they have to make a withdrawal. But to your point, I agree. If you're going to make a withdrawal, make one that justifies the expense.
The other question from Rowan, and this question reads, what return on committed capital is there as investors wait for a project to close? It's quite, it opens the door also to 40 and to 41. And just explain what they are, Justin, if you would first, and then I'm sure Andrew will give us some update on the Albuquerque project. But what do you get any interest on committed capital, especially now that interest rates seems to be, well, are much higher than they were in the past?
No, Alec, we don't, and it is a problem, guys. And I must be very honest with you. We aim to acquire a building. We go through the whole due diligence process, and as any of you who have committed to Med 40, which closed yesterday, that was a lengthy process. I think, Andrew, it must have taken you sort of 4 or even 5 months to close, and lots of hiccups along the way, which is enormously stressful for the team. But if you had invested on day one, you would have had your money dormant for 5 months. The solution that we offer is, number one, we've got that note that you can leave the money in the note until such time as the building transfers. In case there is a delay, the note earns 4% annualized interest. So it's not a fantastic rate, but that is unfortunately all we can do in terms of giving you interest on something we're not really earning on. So that's the solution to Rowan's problem, Alec. And then I think that the other issue was, did he say bank accounts?
Yeah, he had a second question about is OrbVest looking at helping investors open offshore accounts to keep all dividends offshore?
I'm going to defer both of those to my esteemed banking colleague.
So I think, in general, the answer is no from a transactional bank account point of view. I think if we look, internationally, it's becoming harder to open offshore accounts. For example, in the States, if you are not an American citizen, the majority of the banks, you actually have to physically go into the banks to be verified, to hand in your KYC documentation, and then your bank accounts have to be transactional in nature. This isn't the case with all countries, and many local banks do assist you with opening offshore or currency accounts. However, a benefit of OrbVest would be, although not a bank account in the traditional sense, we have what you call a wallet. And this is the account, as Justin mentioned, that sits with Merge, the Seychelles Stock Exchange, which is effectively a trading account offshore. Your money is kept in that trading account that you can view, that you can see on your profile. The dividends returns are paid into that account or that wallet, and your funds can remain in dollars. They can be reinvested, stay offshore, and only at the point of wanting to withdraw those funds would you then have them paid into a nominated bank account. So be that, an offshore account if you had one, or a local account. Alternatively, you may not have an offshore account currently, but you do want to still have your money offshore, keep it offshore whilst you're in the process of sorting that offshore account. And at least with that wallet account, you are able to keep your funds and your dividends and returns offshore in dollars. Obviously you would disclose your foreign earnings in the jurisdiction, that you pay your taxes. But that way you are able to keep currency in dollars offshore.
It's quite a scary situation that if you want to open an account in the US, you have to actually walk into the bank, especially as South Africa looks like it could, would, should become grey listed, which would bring even more onus onto South African investors. If grey listing were to happen, what would the impact be then on our community who have invested with OrbVest?
Well, I can answer that. It would be zero, because effectively they've already moved their money offshore, or they are moving it in any event to another country. The Seychelles is also not whitelisted, as a lot of the islands. In fact, most of the islands aren't whitelisted. So the impact will be zero, as far as I can tell. And maybe, Alec, right now would be a very opportune time to do what we perhaps should have done in the beginning, and I'm going to put that slide up if you don't mind, because we are required to do so. If you can see that one, and Emma, maybe you want to talk to it, seeing as it's your new baby.
Yeah, really just our standard disclaimer. OrbVest is a registered financial service provider, but please note, in this discussion that we are not giving investment advice. Always important to engage with your financial advisors who will look at your holistic investment strategy and financial position. There is no guarantee on our returns, and the past performance on our buildings does not guarantee our future performance. Get the disclaimer out the way.
Okay, the disclaimer was always going to happen, and it has. Thank you very much. I think most people nowadays know that these kind of conversations do come with lots of T's and C's. But Andrew, maybe before we go any deeper into it, just give us an update on the Albuquerque property and the way that the market is going in the United States now, because remembering that everybody in South Africa is looking at the US as a place that's far, far away. They don't really know. We read a bit, but we don't get the opportunity to understand the detail. And indeed, the 5 months that it took to actually close the property, why did it take so long? And those who have now finally been invested there, what can they look forward to?
So the Albuquerque property, as we mentioned, did close. I was there Friday visiting the property. I wanted to monitor the situation when we were buying the property. We had a new tenant who was coming in. They're currently under construction. I walked the site, wanted to make sure everything was going to be delivered on time for the investors, because obviously, we want that NOI that was promised from that tenant, which will come in. But what, people asked of especially our investors, why Albuquerque? Where is Albuquerque? I mean, if you look at a map of the United States, I'm sure foreigners say it's in the desert. Why are you going all the way out there? Albuquerque is a tremendous city. It's a small US city, but the population is the most highly educated population in the United States. Over 60% of the population have a master's degree or better. You have a tremendous amount of high-tech companies that are there, military and so forth. The most interesting part is in the office and medical office sector, and in the the multifamily sector, vacancy is only 5% in this city. It is very difficult to find space. You have buildings that were bought pre-COVID that are 30 years old. The landlord has made no effort to upgrade them or improve them, but the rents that they are charging are double in less than 3 years because of the lack of opportunity to rent in the city of Albuquerque. The demand is far exceeding the supply in this city. It's unbelievable what is going on. We have vacancy in the building, and we were asked why by the lenders, and you asked why did it take so long for us to do. They couldn't understand, given this perspective, why this building wasn't completely full. It was only because the former ownership decided not to pursue it. They wanted simply to leave something for a new buyer to take an opportunity to improve their investment. So that's the reason why they never let it. I, on my first day as owner on Friday, representing OrbVest, already met with our leasing team. We already have a prospective list of 5 groups we're going to talk to immediately. We are very bullish that we think within 6 months we'll have the building 100% full.
Justin, this is a goodie.
Yeah, no, it's one that I particularly like, Alec, and I think that what we've noticed is sometimes the big funds and the big money really focus on New York and California, and that's why those buildings are so super expensive. But if you go a little bit to the less known areas, then you can start to find these deals. Not many, but you can find them. I mean, this is 85% leased, Andrew. And both of those tenants that are in there at the moment are high credit tenants. I forget exactly what the credit level is of them, but they're high credit tenants. In other words,
you have Quest Labs, which is a AAA credit laboratory corporation, all over the United States. This facility in Albuquerque actually is their district laboratory servicing the entire state. You have Washington Federal, which is a very large insurance company. And the tenant coming in is a plastic surgery group who is a national plastic surgery group with over 40 locations throughout the United States.
And I think, Andrew, just to add to that, I mean, they were spending in excess of $1 million launching this facility, and they have contributed, in addition to the landlord, and I remember it was in excess of $1 million to the TI to put in their surgery centers.
The combined build out for these plastic surgeons is $2.3 million.
So they're not going to be moving anywhere anytime soon.
They're not going anywhere anytime soon. And look, they targeted this building, this site specifically, because it's at the crossroads of the major east-west highway and the north-south highway, specifically to draw. They're envisioning drawing from as far as an hour and a half away patients to come to this facility.
But Justin, when you've got such a good project, and it sounds like this is a little bit of a jewel compared with, and not to say that the other projects are bad, but it looks like something fairly exceptional. Why then would you have your ODHs? So in other words, why would you rather go for a lower risk option where you've got an investment in a number of properties like you've got on your ODH, or rather than just trying to find the best of those, which this certainly seems like one? Maybe, Emma, maybe that's a question for you, given your banking background.
Perfect. So Alec, I think back to, what Justin had spoken about previously with property, not being a straight line, some investors liking more of a conservative investment approach, and the reason for those funds existing to level out the bumps that any single building investment may have. And that's why, the fund type of investment approach mitigated and smoothed out the returns. So what we did, a few years ago was we launched what we call the OrbVest Diversified investment option. So we call it ODH1, where we took 5 or 6, a small, slot in a number of our buildings, where we predominantly don't have partners, we own the buildings, and we lump those buildings together. They were so popular, we then launched an ODH 2, 3, 4, and 5, and have recently been through the process of consolidating these into one investment, as we now know it to be the ODH 5.2. And what that would do would give you exposure to 26 of our buildings, where the returns are now underpinned by roughly 100 tenants. So this definitely smooths out any hiccup on a tenant paying. If you're in a single building with 4 tenants and 1 tenant doesn't pay, you've lost 25% of your income stream, give or take. Whereas if you have 100 tenants and 1 doesn't pay, your 7% cash on cash dividend may be 6.8, 6.9, but doesn't really make much of an impact. In terms of, again, this ODH, and what we did was obviously take a slug of each of these buildings and allocate it to this diversified portfolio, which provides a great opportunity to new investors, because they're going to get exposure to buildings that we have closed out on some years back, but also still we have capacity to add in a few new buildings that we will be looking at into that. And back to a previous question I think Rogan had asked with regards to, funds sitting and not earning whilst we were waiting for buildings to close, like Medical 40. So what would happen with the ODH is you pretty much would start earning those returns within a week or 2 of your funds being invested. So we, on a 2-weekly basis, will take the investments we have, and you would start earning the equivalent of your 7% per annum. So it really is a wonderful option for investors that are looking for a spread of our buildings and not just a single building investment. But Alec, to your point in terms of, Medical 40 being a wonderful building, what many of our investors have done is, and that have invested with us through the last couple of years, is that they will invest a little bit into each of our buildings that we purchase. So effectively creating their own diversified portfolio by spreading their investments across the board of our buildings.
So interesting. Yeah. Devon's got a question. He says, and by the way, if you've just joined us late, or if you haven't had the opportunity, and you are live, because a lot of people will be watching this recording, go onto the control panel and click on the little question mark, and you can type in your question. We haven't got that long to go, about 15 minutes left. So if you've got a question, please get it up there as soon as you can, because we will close off in 15 minutes time. Devon's question was, of the 10 buildings I'm invested in, only 2 are meeting targets. Reasons I've been given are vacant space, not let per plan, unexpected maintenance, higher insurance costs, and tenants leaving unexpectedly. Going forward, how are you changing your due diligence and modeling process to ensure more accurate return forecasts? Justin, that's a toughie.
No, that's always a good question. I think, Alec, property isn't a straight line. And while we will forecast, for example, a 7% annual return, that is an annual return. And I'll give you a very specific example, which I was at the building 3 weeks ago, and I could not believe it in myself. But this is one of our beautiful buildings, the Tavali building. I think it's Medical 30, Andrew. And what happened is there was a sewer backup, if you can believe it, and the sewage ended up damaging the soft wall of the medical practice downstairs. And in the US, that's just a no-no. You can't just bring some paint and touch it up. So we actually had to replace soft wall. And while that was happening, the compressor and the air conditioner packed up. So I mean, you have these just strange lumps that you can't just paste over if it's a single building. And in that building, we actually paid 0 dividend in that quarter. But of course, over the course of the year, we still anticipate that it will be 7%. Obviously, there's insurance claims, there's all sorts of things that will come in, but you can't necessarily smooth over the returns over every single quarter. It's not a fixed investment. It's an investment in a property. We get rent in, we take the money, and we distribute it. So as far as underwriting is concerned, I think the problem is not necessarily on underwriting. The problem is that we have had a bumpy period, guys. We've had very interesting inflationary factors. I can talk specifically, and I don't want to get into all these little nitty-gritty details, because I don't think that's what Devon is looking for. But specifically insurance, Alec, there are 3 insurance companies working in the Florida state at the moment. Everyone else has pulled out, and I think you know why. But the ones that have stayed, the insurance has at least doubled. And on our new acquisition, the building that we bought in Boynton Beach, which is, by the way, probably my most favorite building out of the whole portfolio, on closing, they produced a new invoice, and that was for double 2x the insurance, which is obviously a big amount for annual return. So those little things, you can never really anticipate that that's going to happen, because there's been hurricanes or whatever it is. And so while we can do our best to make sure that there's enough cushion to allow for some of these things, if we put too much cushion, then the return goes down. So the best thing to do is to lump them together and put them into a portfolio where if one goes down, the other one goes up. It just means that there's a nice, smooth return for everybody. And that's what we've been able to do consistently with ODH for its entire life. And I'll add another one. We have one of the sponsors that we inherited, Alec, and I think I told you about this particular guy. And people ask us, so, how can this happen? And I think it can happen. I mean, this was a company that, it was obviously a long time ago. It was before a lot of us on the screen were involved here, but the company has been around for 47 years, building medical office buildings and hospitals, very reputable. We then partner with them, and suddenly the guy gets into trouble now, specifically over COVID, but we won't blame that on him. And what do? Well, that's why we are here. We are here to make sure that you don't have to go and try and manage your building overseas. So I'm going to give you an example. Medical 26. It's a magnificent 300,000 square foot building in Dallas. It's a beautiful glass building. And we've got quite a few of the community that are in that building. The guys completely has not maintained the building, is not been looking after the tenants. It is fallen into disarray. It is chaos. What have we done? We've done what we've got to do. What's our responsibility? We've stepped in. We've taken control of the building. We've put in our own dollars to fix it. We've got the bond up to date. We've negotiated directly with the current bank. And this is, by the way, Andrew's online here, so he should be telling you the story. But we are fixing this building. And that's why we're here. Otherwise, go and buy your own building. You'll probably do a bit better. So I think that really answers the question. I don't know about underwriting. I think that, yes, there are learnings on every single building. But Devin, the answer is you can get a slightly higher return if you could buy the building individually. And yes, you might win a little bit of a jackpot. But my favorite product, particularly that as I said previously, I think, Alec, I would put my granny into if she was around. And that is the Diversified product. Reason? Because it's just safe. You just don't have to worry every quarter. Your 7% comes into the bank. And guys, please take you back to the disclaimer. I'm not allowed to use words like safe, but anyway. Alec, I hope answers the question.
I'd like to say one more thing to that with the underwriting, because being on the acquisition team, obviously, that question comes back to us eventually on what we projected. When we do our underwriting, it's not only the returns. Our primary responsibility at OrbVest isn't just the returns, but it is also the preservation of that equity in the project. And that goes into our underwriting. So in Justin's example for Medical 30, which I'm sure there's investors on this webinar now that are in that investment, while I hate that we didn't give them a dividend this quarter, the backstory is with those expenses, we also did let 3 spaces this quarter, which are only going to improve the future, and it preserves their value, and not only their eventual exit is improved now even further than what we hope we projected because of these new tenants.
So there's a lot of complexity. Mark wanted to know, he says, excuse my ignorance, or excuse me asking, he said, but what is ODH? Maybe you can just repeat that for Mark's benefit,
yeah.
Emma.
It's just short for OrbVest Diversified Holdings. So it is the investment where we have put together now 26 of our buildings. 5-year investment period. We projected a 7% cash on cash per annum paid quarterly in dollars, and an internal rate of return on the exit of those buildings at just above 10%.
All right. Well, that explains it for you, Mark. And to Justin's point of diversification. I don't think that anybody who's lived through the past year as an investor needs any teaching on the value or the benefits of diversification. Len says he's got a compliment for you. He says, the returns I'm receiving via OrbVest outperforms all my other investments in South Africa without considering the deterioration of the rand. Is this a common refrain that you would get from investors, Emma?
So I think if you look at the investment or your returns in rands and dollars, you can actually we are getting a better return in dollar terms, not taking into account the exchange rate. And those investors that we're sending money over at $14, $15, $16, are winning on the exchange as well. It's been a bit of a tricky one at the moment where we've seen the dollar going, above 18, and South African investors are saying, do we send money now? Is the rand going to strengthen? When do we send money? And we wish we had a crystal ball on that. But, to continuously send funds offshore, it kind of evens out. And then when your returns are in dollars, once the money's there, that's great. And we also do have investors from currently over 30 different countries. And that speaks to, again, this being a very favorable investment when we have people from all around the world seeking this type of investment out.
Justin?
I think, Alec, your question was around do clients are often thankful about the returns? I think yes, but as I said before, our job is to perform 100% of the time and not 90% of the time or 80% of the time. So we find that it's quite stressful making sure that Andrew doesn't have a medical 30, that even though he's got 3 new leases which are going to fill the building up and add value, we don't pay a dividend, and no one sees the value add. They just see that there was no dividend in the month, and at the end of the year they don't say thanks. I see that you've recovered. So yeah, it is challenging with the single building scenario, but that's ultimately what investors like. They want to see the bricks and mortar. And you come back to your question about Albuquerque. Why people invest in a single building is because they can literally go there and look at the physical building that they own a little piece of.
Yeah, I love the idea of this kind of an engagement as well, because it is going back to our community. It is updating. So often what happens with investments is that people make the investment and then nobody tells them again what's happened to that investment. So thanks, guys. It's great having you on. Paul asks, what are the ODH average returns? Again, we're talking about the pooled funds. It does not seem that you've done that well recently.
I'll take that, Emma. We have paid consistently 8% for the early ODHs, and then we brought that down to 7%. And the ODH 5.2, we've consolidated it at 7%. That's been consistent right from day dot. So that is the story. And on the it actually is the older buildings of which there's very little exposure to that have the problems. The new buildings are all okay. Remember, we're paying 7%, but some of those buildings are supposed to be performing at 7.6% or 7.8%. So the underlying building might be underperforming because it's paying 7, but actually that's fine because that's what we need to return on 7. So it's if you have a look at all the properties that are in that portfolio, the majority of them are performing above the required 7%. So you can see that very clearly. And look at the weighting as well. For example, in Albuquerque, we have $1 million in that, Andrew. So we've got a much higher weighting than we've got in one of the early buildings, which we've got $6,000 of investment in. It's not relevant. So you don't have to think about it. So I would disagree with the fact that the recent buildings are causing a problem. It's not. It's the old buildings which are not relevant because of this tiny little amount of investment relative to the rest.
And Paul's follow-up question is, what is the size of the ODH portfolio today?
It'll be sitting at about $20 million. When we did the consolidation, Alec, it was about 17.5, and then obviously there's been another issuance which happened on the 15th of November.
That's sizable. Final question for today. Can you believe it? We're nearly, sorry, Emma?
No, I was just going to say, that ODH investment is open until December 2023, till the end of next year, where we have to close that. So unless we have raised the sufficient equity prior to that, that is when it will be available to investors until.
So you might have missed out on 40, in other words, the Albuquerque building that has got a lot of airtime tonight, but you can invest in the diversified portfolio. That is open.
Correct.
Final question for tonight. We literally have come to the end of our time. John Kotzer. Oh, sorry, John. I gave your surname. Let's just say John. Please excuse the amateur question. So this fund is basically a property unit trust that pays dividend. What is the last 5 years? He says, all good. Thanks, John. The last 5-year average return on investment. Do I understand this correctly?
Yeah. So first of all, we only launched it 2 years and 1 or 2 months ago. John, I think it was, yes. And John, since then, as I say, it has consistently paid out what we have said it would pay out, which is 8 on the early ones. ODH 1, 2, and 3, I think, were 8. And then it went to ODH 4, I think, was 7.5. And then ODH 5 was 7. And we've consolidated all at 7. So basically, from now on, it will be 7. The underlying investments pay anything from 6.5 to one of them is nearly 10% cash on cash. So within that range, we're able to consistently pay out the 7. Bear in mind, this is not a unit trust. It is a company that owns shares in a number of companies, and so we can't call it a fund, but ostensibly that would be a better name for it. But it is limited only to those 26 buildings that we have in it at the moment. And yes, we might add 1 or 2 new ones between now and the end of next year. But it is only a slither of those buildings. And there are some very strict rules that we have to follow in order to take any investment into that fund. I hope that answers the question, John.
Thank you very much, Justin, Andrew, Emma. Before we leave, just to clarify, the main thought as I would leave here is that the portfolio is looking solid. Of course, it's going to have its bumps, its ups and downs, but on the ODH, in other words, the umbrella company that's invested, that is delivering the 7% return in US dollars, which is very important as South Africans that we recall on that side. The building in Albuquerque is now closed. Andrew, from what you've told us, it's one of those gems. Those who wanted to invest in it, unfortunately, that is now over. But what you are doing as OrbVest is you are being very cautious because of the state of the market at the moment, and you're not rushing in and paying up, even though others are, or some others are. Generally speaking, the American market is very sophisticated, and you aren't finding too many cowboys who going into New Mexico. Andrew, does that pretty much sum it up for you?
It does. Just to say, we still have room for the investment in Albuquerque. So
apologies.
Yeah, a reason being it's actually of ownership, but yeah, we've still got a couple weeks in terms of listing to happen. So if anyone did want to invest in the Albuquerque, we do still have roughly $1 million that we could put into that.
See, that's why you got excited, Justin.
Yeah, 2 things, Alec. I mean, I think it's very important that investors understand that we have some buildings like 26 that we've had to do some very aggressive stuff in stepping in, and so I wouldn't say this is all a straight line, but all the new buildings are performing, and yes, there might be 1 or 2% off here and there, but we expect that in the long run they're all absolutely on track. As I said, with Medical City, the Talawi building, and then finally closing. Just so that everyone understands, closing means we actually hand over the documents and the check, and we take possession of the building. And that is what we call closing. It doesn't mean that the investment is necessarily closed. And the reason why the investment is not closed is because we actually stopped raising money for this, and we went very quiet on it because we didn't know what was going on with the closing process. In fact, Andrew actually got a discount from the seller on this building because of all the various shenanigans that went on sort of as we rolled up to close. So and that's why there's additional equity. How do we pay for the building? We bridged it. So OrbVest basically have bridged it, and we need to obviously get those investors in to take up the bridge.
I'm so pleased that you clarified that. The non-property people, like myself, would have thought closing means closing, but I mean that you can't take any more money. But you've explained that. Just before we go, Andrew, for you, are there some new investments on the horizon that you're working on? This is from Michael.
There absolutely are. We would have thought, given where the economy was 60 days ago, that the well may have gotten a little dry, but because the economy is improving so much more rapidly than we thought, I've actually received 6 or 7 different opportunities that we're starting to look at for the first quarter.
So there's always something happening. Michael, I think my takeaway from that as well is that if you're interested in investing or expanding on your investment, just talk to Emma and Justin. They'll be able to give you the insight. And I'm sure with such a big portfolio now, from time to time, people want to sell and they might want to get out of different investments. And that could be a appealing investment for somebody else. So that's really the message I guess we can leave you with. Last word, Emma, from you and Justin.
No, Alec, thanks so much. And to everyone listening, back to what you said, if anyone has questions or wants to reach out directly, please contact us. Or if you have an existing person that you're dealing with at OrbVest, get hold of them.
Justin?
Yeah, once again, Alec, I can't add to that. Thanks to you. Thanks for the audience. And you see, Alec, I did behave myself with the slides. I didn't put too many up for you.
Justin, I promise you are the best behaved partner that I think we've ever had. So please don't think that I get grumpy when there are too many slides. And certainly in this case, there were it added value. And I'm sure our community, our tribe, are delighted with the opportunity to have got a update. We thank you very much for your time. Andrew, especially in the US, joining us from so far away, although technology makes it relatively easy nowadays. But nice to have you from Atlanta, Emma from Durban, Justin from Durban as well. Is that right,
yeah.
Justin? Yeah, well, you guys have got the best winter weather. I'm not so sure about the summer, but it is always a privilege and a pleasure to be talking with you. Thanks for sharing tonight. And from me, Alec Hogg, and biznews.com, till the next time, cheerio.